It's kind of a technical term here, so let's lay it out for everybody who hasn't been made aware yet. The yield curve inversion. Here's what we're talking about. We're talking about the yield on the 2-year Treasury note rising above the yield on the 10-year Treasury note. It's only happened a handful of times over the last half century, and when it does, it typically happens ahead of a recession. That's the basic outline of what we're worried about today. So Brian Cheung, this is a question that Jay Powell, the Fed chair, has been asked before. Do you guys care about the yield curve inversion? Is that something that you are willing to adjust your policy based on? So I guess from a Fed perspective, do you think the dynamics we've seen in the bond market since the last Fed meeting is going to be impacting how they approach the next several meetings?
And the framing of that question is really about whether or not you think bond markets affect the Fed or the Fed affects the bond markets. We were just talking about the relationship between equity markets and the bond markets, but the bigger question for central bankers is how do their policies affect where the yield curve is, or where does the yield curve affect Fed policy? So what we saw heading into July 31st meeting was that the Fed felt like it maybe had some position to be in the driver's seat. So the Fed lowered by 25 basis points. The idea or the hope was that it would bring down the lower end of the yield curve, because the lower end of the yield curve, the 2-year Treasury, tends to closely track the federal funds rate. So they lowered by 25 basis points. The 2-year fell, I think, by around 17 basis points. So mission accomplished, right? The problem was that 3 business days after the Fed ended up making that cut, we had the issue with China. So the trade issue exacerbated. China ended up devaluing the currency. The yuan popped up to 7 yuan to 1 USD.
Which is what Powell has said all along, that it's about China and global concerns.
And then the yield curve started to tip towards flattening, and then ultimately began the momentum that we saw with yield curve now inverting today. So that would tell you that the Fed is not in control of the yield curve. But the question is that as we head into the next September 18 FOMC, and actually even just next week, there's going to be a big conference in Jackson Hole where policymakers will be asked, because I will be asking some of them, about what the policy is going forward because of the fact that the yield curve has inverted, because they do watch it very closely. So the question here is really going to be about, should they lower interest rates by more aggressively in that September meeting to try to get the yield curve steepen, even though that's not one of their dual mandates?
Yeah, and I guess, I mean, another thing that I don't know if we've discussed this enough yet is kind of what's the plain English here on why it matters, right? I mean, what is that saying when you have shorter term interest rates higher than longer term interest rates?
Right. So basically, you have to think about the bond market in terms of investing, right? So you would invest in a 10-year bond if you feel like things are going to be better 10 years from now than you would if you were to invest in a 2-year bond, because
it's Warren Buffett.
Right. So
no, I mean, it's being bullish on the U.S. economy and big blue chip companies for a long time to come.
Well, then discounted by the amount that you get paid every year for lending that money.
Regardless, the point is you're investing on the time frame. You're not investing on the underlying security. I mean, it's perceived that it's a relatively, nothing's ever risk-free, but a relatively risk-free asset. So when you have inflows going into a certain bond, the bond yield comes down, right? Because the actual underlying value of the bond goes up, and then the payment on the yield doesn't need to be as high for people who want to be invested in it anyway. So if there's more inflows or demand for a bond, then you see the yield go down. So the 10-year came down. Actually, yields across the board came down over the past year or so because of the fact that there's been concerns about what's going to happen here in the U.S. But it seemed like there were more inflows into the longer-term bonds than there were in the shorter-term bonds, which means people don't want to touch anything in the short term, even in the risk-free market. So to translate this to people, the reason why the yield curve inverted today is because people are scared to invest in in the shorter term window. And because of that, that's what's spelling the sentiment. Again, the yield curve is not the reason for why a recession happens, but it's an indicator because it measures sentiment over that time frame.
And that's the reason I invoke Buffett, only in the sense that we're talking about, with the long-term bonds, you need to have high faith in, the economy and in growth to come.
Well, or you're scared about what's around the corner.
Right.
I mean, you want to be compensated. Anyway, fine.
Right. Yeah.
Have a discussion many more times.
Yes.
I mean, we're saying the same thing.
You can put it even more simply, which is just, you would think that the long term would yield higher than the short.
Well, yeah, bullishness.
Those lines shouldn't cross.
Bullishness in the future is not the same as bearishness.
It's not the same as bearishness.
Right.
Right, exactly. There you go.